Welcome to Decision Vision, a podcast series focusing on critical business decisions. Brought to you by Brady Ware Company. Brady Ware is a regional, full-service accounting and advisory firm that helps businesses and entrepreneurs make visions a reality.
And welcome to Decision Vision, a podcast giving you, the listener, clear vision to make great decisions. In each episode, we discuss the process of decision-making on a different business topic. But rather than making recommendations because everyone's circumstances are different, we talk to subject matter experts about how they would recommend thinking about that decision. My name is Mike Blake, and I'm your host for today's program. I'm a director at Brady Ware Company, a full-service accounting firm based in Dayton, Ohio, with offices in Dayton, Columbus, Ohio, Richmond, Indiana, and Alpharetta, Georgia, which is where we're recording today. Brady Ware is sponsoring this podcast. If you like this podcast, please subscribe on your favorite podcast aggregator, and please also consider leaving a review of the podcast as well. Today we're going to talk about hiring an investment banker. And I think this is an important subject because investment banks, I think, oddly enough, have a lot of mystery around them. In many cases, particularly if you're a small business, you may only use an investment banker once in your entire life, maybe even hopefully once in your entire life. You do one exit, you make a boatload of money, and then you get on your yacht or you go to your mountain villa or your Italian Sicilian hideaway and never have to do anything again. And one of the parties that kind of makes that possible for that lucrative exit is the investment banker. Now, I happen to have a lot of respect for investment bankers because early in my career, I did the investment banking thing. And let me tell you, I'll get on my soapbox a little bit, and I have no problem with that. For all the junk that investment bankers take, and you hear investment bankers brought up in Congress that they don't pay enough taxes and whatnot. I challenge any of them to walk in the shoes of a successful investment banker for 2 years and see kind of how they do with that. It is not a 9-to-5 job. Unless your definition of 9 to 5 is 9 in the morning to 5 in the morning. It is not a Monday through Friday job. It is an always on job. And I can tell you for a fact that those folks, if they're successful at all, really earn their fees. And if you don't kind of live that lifestyle, you just are not in the business very long. That's just all there is to it. And so I washed out, and I took a step back and I went into business valuation, which is, let's say, a much more work-life balance friendly, profession, although sometimes my wife will wonder about that. But I wanted to kind of get that on the table because when you hire an investment banker, it's a very important decision. If they're any good at all, they ain't cheap. And they can often be the difference between an exit that makes you comfortable for a while and maybe pays for a vacation or some of your kids' education versus retiring or possibly leaving or creating legacy wealth. So with that, let's kind of introduce our guest here. I have with us Roger Fuhrer, who is a director at Brady Ware Capital, which is our firm's captive mergers and acquisitions specialized business unit. And they help business owners and entrepreneurs understand, increase, and unlock the value of their businesses. Business owners often find that managing the complexities of transactions an overwhelming experience. And they can even find it overwhelming when they have help. I can tell you that for a fact. And you need an advocate that's going to be out there representing you aggressively in the marketplace and helping you find not just an opportunity, not just, Mr. Right or Mrs. Right now, but Mr. or Mrs. Right. And that's what Brady Ware does. And they help ease those challenges and allow you to continue running your business successfully throughout that transaction. That part's really important because I can tell you, having worked on a lot of transactions myself, not in the investment banking capacity, but as the advisor, selling your business is so physically and emotionally consuming that it can be difficult to actually continue running your business and sort of forget. You can easily lose sight of the fact that until that money hits escrow or until that money hits your bank account, you get a wire confirmation that deal is not done. And if you are not paying attention, all of a sudden you may be left with a less valuable business than what you started with. But we'll get into that. Roger joined Brady Ware's mergers and acquisition team in 2016. And as I said, he's a director. He has more than 30 years of experience in banking, i.e. 15 times more than I do, where he led teams focused on middle market companies. He leverages his banking experience with middle market companies to help family-owned businesses and management teams maximize the value of their investments. Specifically, he guides business owners through the sale of their business or assists them in securing the liquidity needed to grow that business. And with that, Roger, thank you so much, and welcome to the program.
Thank you, Mike. I appreciate being a part of the discussion.
So, Roger, let's start with some basic vocabulary, because I'm not sure everybody knows what an investment banker does. I think there's an image out there of what an investment banker is, but I think there's a misconception. So, kind of in your own words, if you had to kind of describe your job, what is it?
Well, sure. One of the things that people misconstrue about the term is when they hear investment, they think it revolves around stocks and bonds and that type of thing. So that's one thing that we're not. So I would say investment bankers do a multitude of things. Some have more well-rounded services than others. At Brady Ware Capital, we help companies evaluate their strategic options around how do you liquidate or transition your business and discuss possible selling options for them. Or we also help them uncover perhaps opportunities to acquire other companies or merge with other companies and analyze the returns around that. At Brady Ware Capital, too, we also help companies raise the appropriate bank debt or subordinated or mezzanine debt for the situation that they're dealing with.
Okay, yeah. And so, so when we say investment banker, one, I mean, you're not lending money yourself, but you may be an intermediary to the folks who are lending money. And, that first job description that you put out there really is more of a wealth or financial advisor when you're dealing with analyzing stocks and bonds. And maybe the exception may be if you're the kind of investment bank that is taking companies public and you're dealing with public securities, but that isn't you guys, and for the most part, that's not going to be our listener base. So we can probably set that definition to the side, at least for the moment. So one thing, and I have to confess, I don't really know the answer to this question in a very clear way. So I'm very curious to hear your answer to this, and that is, what is the difference, if there is any, between an investment banker and a business broker? Because you hear those terms both used a lot. But I also know many investment bankers that bristle a little bit if you call them a business broker and vice versa. So I'm curious, is the difference meaningful? And if so, how would you characterize it?
Well, first of all, Mike, I'd say that there's a lot of overlap in the term. So I think when people define a broker, they think about a transaction being completed, a commercial real estate property, a residential property, a broker being someone that executes a trade of a stock or a bond. So I would say that I am a business broker, but I would prefer to be identified as an investment banker more so, that also helps bring the transaction to fruition. So I think in our terms and in the markets that we deal with, I think business brokers generally deal with smaller sized companies and typically list the business for sale and identify an asking price for that business, much like you would with a piece of real property. I think the difference between an investment banker, I believe, is in a higher strategic value proposition, if you will. where when we're representing a company for sale, we go about an entire marketing process and identify who we see as the best strategic and financial buyers for that entity so that we're able to drive the highest and best value for that company. I hope that helps you from a differentiation perspective.
It does, and not to suck up to you because I'm not. It's actually the best definition I've actually heard, the best distinction I've actually heard between the two. So for the first time, I think I could actually explain it to somebody else, which is the definition of a good understanding. So, what does the investment banker client relationship look like if it's a very good one? I think when clients sign on to pursue a strategic transaction, I'm going to use that generic term deliberately for the moment. I sometimes wonder, particularly if they've never been in that kind of transaction environment before, if clients really, frankly, know what it is that they're getting into. So maybe, could you kind of shed some insight and give us some of the inside baseball in terms of what that relationship looks like on a day-to-day and a month-to-month basis?
Sure. And maybe to define an ideal relationship, I kind of start by saying the process to sell a business and to discuss the strategic options leading up to selling a business could be a 6 to 9 to 12 month process. So with that being said, you're going to spend a lot of time as the business owner with the investment banker that you choose to work with. So I think it's very important that you have a degree of chemistry with those folks, that everybody likes working with each other, and that the investment banker's able to also work effectively with the management team of the company and work with other outside advisors, such as their attorney or accountant, et cetera, that's going to be working through this process. And the reason that it's important, it's not so much the time frame, but it's the intensity during that time period. I might talk with my customer daily, twice a day, many times a day, depending on where we're at in the process. So there's a tremendous amount of interaction that you're dealing with during the course of the process of selling a business. I think the other thing that I would suggest that somebody look for in an investment banker, and I'm sucking up a little bit and touting some of my background, but I think somebody that has had some experience, a multitude of experience in different business environments, because there are technical, legal, accounting, financial, emotional, all kinds of issues that come up during the course of the process. And so I think dealing with somebody with a well-rounded background is also very important in the process. I'll
underscore that because that's also important in what I do. As you know, and if our listeners have listened to these other podcasts, I specialize in technology businesses and professional services firms, i.e. businesses that have mostly intangible assets. And, the process of selling, buying a business in those industries is candidly very different from, say, buying or selling an orthopedic practice or even a manufacturing company or a high-tech engineering situation, although engineering, I guess, is professional services. But the point is, all these kinds of transactions of businesses have their own little nuances that have to be figured out and anticipated, preferably well in advance. And there's a lot of value to having seen a lot of stuff, because every deal will have a surprise or two. That's just unavoidable. But you'd like to keep those surprises down to a minimum, to a dull roar.
Well, and the ability to draw back on past experience and be able to connect the situation from one experience to another and say, in this situation, this is how it was dealt with, as kind of a starting point in understanding the discussion.
Yeah, as I like to say, that there needs to be some benefit in my case to having gray hair and two arthritic ankles. And what you get in exchange for that is a little bit of experience and been there, done that, and got the T-shirt. So one thing that I think a lot of folks don't know if they haven't worked in an investment bank yet is that there's a difference between sell side and buy side transactions. With of course a sell side transaction meaning that you're working for the seller, and a buy side transaction meaning that you're working for a buyer. And most investment bankers I know, and I truly don't know if this is the case for you. I should, but I don't. But most investment bankers have a preference to work on sell side transactions. So I guess my two-part question is that the case for you guys up at Brady Ware Capital? And if so, why is that? Why is there a preference to work on the sell side?
Well, it's interesting that you bring this up, Mike. This morning I was talking to another investment banker that we have a strategic alliance with, and we were introducing ourselves to another party, and they asked if he does buy-side engagements, and he said, no, I flat out refuse them. So
yeah, I've heard that.
So first of all, Brady Ware Capital's preference is most certainly to do sell-side engagements. We do take on a limited amount of buy-side engagements when the situation seems right for ourselves and the client. But the reason for the preference is, and this may seem a little bit strange at first, but with a sell-side engagement, you have one willing party to start with. You have someone that has engaged you to go find the buyer. They're ready to sell. When you do a buy-side engagement, the buyer says that they want to grow from strategic acquisition or otherwise, but in many cases, it's very difficult to define what it is that they're looking for and trying to identify the right party to be a participant on the other end of the transaction. And if you're able to find the perfect fit and talk to and find and get financials and identify the right selling party for that transaction, well, they weren't for sale when you called them. So you kind of flip the leverage in terms of the monetary value that is going to be exchanged. You kind of flip that leverage over to them because you've reached out to them and created a situation that they weren't ready for. So it would be the same thing if I showed up at your doorstep and your house wasn't for sale, but I said that I wanted to buy it because it was the perfect fit for me. And you kind of take a step back and go, well, I'm not really for sale, but if you paid me 50% over market value, it might be for sale.
Yep, that's right.
And so when that happens, right now, my buyer, who was a willing participant, says, well, wait a minute, I'm not going to pay that for that company. So it's very difficult to find the perfect fit in a buy-side engagement.
It's like trying to solve, one equation with two unknowns, I guess. And, for the most part, at least larger companies, that they won't hire a buy-side investment banker representative. And that's why they'll hire instead a vice president of business development, or they'll have a corporate development team if they're large enough. And that's kind of their job to go out there and hunt for those businesses to acquire. And that's probably the more common model, wouldn't you say?
I would definitely agree with that, Mike.
Yeah. So how do folks like you, frankly, get paid? In my practice, 90% of my fees are on a fixed basis. I don't think the investment banking world really works that way. So, how are investment banking fee structures on a sell side engagement typically put together?
Well, I wouldn't have answered it this way except for how you stated it, with yours are 90% fixed. Ours are probably 90% variable. So for the most part, we are compensated when success happens. And that's back to your introduction. That's when the wire transfer goes through. So most investment bankers will receive a retainer at the beginning of of a sale process, and they might receive another retainer or two, throughout the course of the engagement at various stages in the process. But most of our fees come from the transaction success actually happening, and those fees would range from roughly a few percentage points on up to maybe a 7 or 8% of the sale, depending on the size of the transaction.
And the risk level, I would imagine, as well, correct? In other words, if you think the deal is going to be easier to do, the fee might be a little bit less. Or does it matter? Maybe it doesn't.
I'll answer that a couple ways, Mike. One is, since by our very nature and the kind of the structure of our pricing is built around success, the idea is to identify projects that we would work on that we feel that we're going to achieve success. And that's, mutually determined between ourselves and our client. In other words, if we value the business, I'll just use a number of 5 million, and our customer says that I'm not going to sell for anything less than 10, then we probably don't see a pathway to success with that. At that juncture, we might work with the customer more about how to achieve a valuation of $10 million at that point in time. So if we don't see a pathway to success, I'd say there'd be two things that we would do. One is not become engaged, or secondly, if the client wants us to continue through a process, we would probably change the pricing structure so that it's more fixed versus variable.
Got it. Okay. And the way you described that just made me realize something. And it goes back to the previous question of buy side versus sell side. If your compensation is going to be a factor of or driven by the size of the deal, and you're working on a buy side engagement, you're kind of working against yourself, right? Because you'd be trying to drive down a price, but in so doing, driving down your fees. That would be a pretty hard balancing act to sustain in any event.
Yeah, we're a little bit, and our pricing structure, we like to be in mutual lockstep with our clients so that we're not in a situation like that where we're not trying to drive the price down, so we drive our fee down. Correct. All right. And also back to your buy side situation, because I described before that, it's difficult to identify and achieve success with it. And that's the nature and structure of our compensation system, is based on success. You don't want to get into a lot of situations where you don't see a pathway to success. Yeah,
that's a good way to not be in business very long.
Correct.
So, take us through a sale process. Let's say somebody has been, you're now engaged and you're ready to put a business on the market for sale at some point. I'm guessing there's some preparation that goes into the process, but I don't want to answer that question. I want to let you answer that question. What does that process look like?
Sure. I maybe before getting engaged, I'd like to, take a step back and, discuss the process of getting engaged. So, it sounds a little bit like a marriage here, but so what are you trying to accomplish, business owner? What are your objectives? Are you trying to transition your business to your management team? Or are you trying to transition your business to relatives, cousins, daughters, sons, whatever it might be? Or are you trying to exit 100% of the business and sell to a strategic party, a financial party? Are you trying to retain some ownership and partner with somebody to take you further and help you grow your business in another direction, perhaps geographically or from product diversification, whatever that might be? So I think the first part in thinking about a sales process is really identifying and discussing, what are you trying to do with this? What's the right solution for you? Because that's going to drive the marketing process that we go through.
So
is that helpful?
No, it is. And I'm glad you brought us back to that point, because I think it's very important that I'm guessing the process or the number of clients that you or any good investment banker has, or somebody just sort of calls you up and says, "Hey, I need an investment bank." Great, I'll send you a letter, sign it. Next thing you know, you're engaged. I'll bet that's pretty close to zero, right?
That would be less than zero, yes.
Yeah, right. So you've had months of conversations. This is something a lot of people don't realize about investment bank is folks like you invest a ton of time, energy, and expertise in that pre-engagement relationship building period, where you're trying to understand A, the business, and B, the goals of the owners, and make sure those are something that you can realistically accomplish.
That's correct. And as part of that process, it's also identifying a value range of that business so that you understand what the potential outcome could be as a result of the marketing process. So back to my example of the $5 million valuation, where the business owner feels that 10 is their exit number, then we've got to step back and talk about ways to get that business valuation up. So, I digressed a little bit from your question on the sales process and what happens when you get engaged, but I thought that was a good backdrop. With that being said, so to directly answer your question, through an engagement process, and we describe it as several different steps that we go throughout that 6 to 9 month process that we discussed before, where we literally write marketing material on the business by gathering financial data, understanding the products, the markets, the sales process, whatever it might be that are positioning the business as to why this is an outstanding investment consideration for a potential buyer to look at. So we go through entire marketing process and understanding the business. And then as part of that process, we set down and identify who we see as potential buyers for this business. And how we do that is we review companies that might be direct competitors of the customer. They might have ancillary businesses associated with this particular business. They could be large suppliers to the business, or have other strategic interests that could align with purchasing the particular company that we're representing. We also identify what we'll call financial buyers, who, broadly speaking, would be identified as private equity groups or perhaps family offices that engage in private equity transactions. Private equity can be a very powerful option for people, especially who are interested in retaining some ownership and continuing on a go-forward basis. Typically, these financial buyers also have a strategic interest in an industry. So a private equity firm that has a specialty in managing manufacturing companies probably isn't going to be interested in their retailing business, as an example. But it's usually something that's tangential to the business that they're already in. So those are the things that we go through at the start of that process, and then we literally do hand-to-hand combat outreach to the leadership team of these prospective buyers, and send marketing material to them in an attempt to get them interested in this company.
Yeah, I like the way that you mentioned that hand-to-hand combat, and just as an aside, interesting you bring up family offices, because I think that's a relatively new trend. When many of us think about financial buyers, we go right to private equity. But as you know, I'm doing an increasing amount of work with family offices and dynastic wealth, and they're starting to become a more important player in as a financial buyer of buying operating businesses. At least I'm seeing that. Are you seeing the same thing?
We are. They too, like others, are looking for profitable ways to deploy the capital that they have to invest. And they see this as one of the avenues that they might allocate a portion of their portfolio.
So typically, and let's do a range here. I don't want to nail you down, but I still think it's important in terms of managing expectations. When you and a client agree to work together, excuse me, how do you set expectations, or what expectations do you typically set in terms of how long it'll take from, we're signing this engagement letter until you're going to sell the business and money wire transfers go through?
Sure. I'll start with the end answer, and I'll break it down in stages for you, Mike. The end answer is probably 6 to 8 months from the start of the process to the wire transfer clearing. We say it's about a month doing our market preparation and marketing material. Another month to 6 weeks in terms of executing the marketing process and identifying potential buyers and outreach and getting indications of interest from those buyers. Another 6 weeks or so in terms of providing additional information, hosting those companies on site for visits, and ultimately picking the right party and negotiating a letter of intent that we all agree on. So that's about, I'll call that, maybe 4 months total there. And then it could be another 3 months or so to, develop documentation, do the due diligence research that the buyer is going to do, and ultimately get to the closing process.
So there's a question I want to make sure that a conversation I want to make sure I have with you, because I think this is very important for our listeners, and I'm sure that you've addressed it. And that is part of the compensation model is that there's a retainer involved. And to be candid, I actually advise clients that hiring an investment banker that requires a retainer, I think, is a good thing, because that's what helps keep the investment banker interested, especially when the deal isn't particularly active, as opposed to, and we know and business brokers tend to be more like this, so they'll operate without that retainer, where, there's purely a success fee out there, and you're going to get the very definition of ADHD, in that whichever deal happens to be getting traction today is the one that's going to get your attention. And that means that yours is going to go to the bottom of the pile. Can you comment on that? Does that make any sense to you?
Well, I would say what went through my mind, Mike, is I've seen investment bankers that charge a monthly retainer. I'm not a big fan of that. And in advising a client, I would advise a client against that, because that just keeps the meter running and doesn't necessarily drive one to success. The retainer fees that we have and the way that we structure it is around hitting certain benchmarks so that there is demonstrated progress in the work that we're doing. Now, it doesn't necessarily mean that we're going to close the transaction. But for example, having a retainer that hits when the letter of intent is signed, that shows that work was done and progress was made. And this keeps us engaged and kind of covers our expenses and time and effort in working through to the closing process. So I'm a big fan of retainers that way that are benchmark driven. I'm not a big fan of retainers that are driven by the turn of the calendar. Okay,
good. So, have you ever run into a scenario where a prospect kind of raises the question of, well, my law firm says they know buyers and my CPA firm says they know buyers, and maybe I can just let them sell my business and not have to pay the fee. Do you ever encounter that? And if you do, how do you respond to that?
We encounter it frequently. And the way that we address it is a number of ways. First of all, there's many great accountants and attorneys that I've worked with through these processes, and many of them may have the capabilities to do these, I'll call them one-off transactions from time to time, where a buyer reaches out directly to the seller to get a transaction completed. That could work. I don't advise that you should approach it that way, but that could work. I find it, I don't know, I'll use the term laughable that accountants and attorneys would do outreach to identify potential buyers and try and get them interested and do the work that we do. So they certainly have some skill sets that help in the process. But the other thing I'd say is that they're rarely staffed to handle those steps to do it. We work constantly on a deal, and by constantly, we might spend half a day for 6 months on a particular deal. I don't see an accountant or an attorney having the ability to do that based on the other workloads that they have. So we always hear about the realtor sale, the FSBO, the for sale by owner. I certainly don't think that it's the recommended approach. Independent of the advisors, here's the other thing that I think is the critical piece of this. So it's a very specialized and a time-sensitive process, which I've just articulated. But the business owner and the management team needs to focus on running the business and maintaining the value of the business. If you devote an inordinate amount of time to the selling process itself and the business suffers, guess what? You just diminish the value that you thought you were saving by not paying the investment banker fee. So the expression, what's the saying? If you act as your own attorney, you have a fool for a client. I think this is pretty similar to that. You used the term before about, trying to do this, cheaply. Well, we certainly believe 1,000% of the time that the process and the effort and the marketing approach that we do is way, way more offset. Our costs are way, way more offset by the value that we drive in the business. So first of all, don't do it yourself, because your business is going to suffer. If you're in a situation where you can spend 6 to 9 months working on the selling process, I challenge that just doesn't happen in business very often, that you can establish a new role for yourself and not do your current job. So don't do that is my huge advice with that.
So the bullet point here is do not try this at home.
Do not. No.
And I agree with that. And I've seen it happen even with an investment banker involved. And I think, frankly, one of the values that you guys bring to the table is understanding how to manage your client's time to make sure they are still managing their business, because, there's the dynamic at work that if your eye's off the ball on the business, that's one thing. Over time, you can probably recover it. But the other part that I think is extremely hard to recover from is psychological, is that once your mind is kind of 1 foot out the door and you're thinking more about that condominium in Costa Rica than you are your business on a day-to-day basis, I think it's very hard for you to snap yourself out of that and get back into full-on business non-exit mode.
I would completely concur with that. And, I think one of the things that we do in the process is the coaching aspect of it, about making sure that the business is still performing. Now, obviously, situations occur where that doesn't happen, but the idea is to make sure that people are maintained and maintain their focus on where they should be to maintain the value of the business during this, this 6 to 8 month cycle.
So we are talking to Roger Fuhrer of Brady Ware Capital, and we're talking about whether you should hire an investment bank. I've just got a couple more questions, and I want to let you go because I know you've got deals that you're working on right now. But one question I want to make sure that we do cover is, investment banks such as Brady Ware Capital are not just about buying and selling businesses, are they? There are other kind of ancillary, I don't want to say ancillary because that sounds like they're not important, but there are other important services that you offer to clients as well, as do many investment banks. Could you talk about that for a minute?
Yeah, I think a couple things that we do well also, and I think having Brady Ware Capital being a part of Brady Ware, the accounting practice, gives us the unique capabilities of being able to work with what we would call transaction specialists that are able to be participants in a due diligence process and identifying, issues that might arise in the financials of a target company, as an example, or preparing the seller for issues that might come up with their target company. So I would broadly categorize that as transaction services type of work. Additionally, we also participate in what I would call corporate finance, which would be helping companies analyze potential cash flow and return on equity metrics for an investment that they're making, an acquisition that they're making, those types of things to make sure that they're on the right path from a financial perspective. And finally, I believe I mentioned before, we do assist in capital raises. Most traditionally, we have worked in the area of bank debt and other mezzanine debt that would assist the company, with their capital structure.
Now you mentioned debt, sort of noticeably absent in that conversation than is equity. Does that mean that you're not as aggressively pursuing transactions where you might help somebody raise equity capital?
We do not do that as a routine. No, Mike. It's almost one of those situations that I would parallel with the buy side discussion, in that trying to find the right fit of equity participants with a particular equity need is maybe needle in a haystack type of approach. I would say more typically from an equity raise perspective would be around the potential transition of some of the ownership, maybe a minority ownership perspective, to provide liquidity to the primary owner, or perhaps to engage in some expansion activity or acquisition activity. There is a fair amount of private equity groups that do specialize in taking a minority ownership position. So when that scenario arises, that might be something that we would be a part of a process of, and in an equity capital raise. But rarely do we do one-off type, if you will, for smaller dollar amounts to bring equity into a business.
So if Wile E. Coyote's coming to you and he's trying to raise venture capital for his Roadrunner catching machine, that's not a good fit.
I don't know. Wile E. Coyote had some great Acme machines that I remember as a kid. We might invest in that.
Oh, there you go.
But yes, that is not one of our strong suits.
All right. So, Roger, this has been great. There's other questions we could ask, but I know we got to let you get back to it. If somebody wants to contact you and learn more about investment banking and how investment banks can help a company from a strategic perspective, and maybe a little bit more about Brady Ware Capital, how can they best find you?
Well, I'll tell you that, but before I do, I think there's one other point that I think that we should talk about with the listeners. A lot of times we talked about a party not doing it at home yourself type of thing and doing it for sale by owner. When people get outreach from a buyer and who calls them directly and thinks that they they should engage in an acquisition discussion. Investment bankers are very useful in that process as well. In that the first thing that we do is help with the identification of what the value of that business should be, and also kind of go back to the starting point that we had before is what are you trying to accomplish, business owner, around your goals and objectives with transition. So I just thought that was worthwhile to bring up too before exiting. With that said, and to answer your question on how to get a hold of me, my email address is rfurrer, F-U-R-R-E-R, at bradyware.com, or anyone may reach me on my cell at area code 937-238-9401.
Okay, Roger, thanks very much for that. I think there's a lot of good content for somebody who's thinking about whether or not they need to retain an investment bank. Chances are, if you're thinking about it, you probably do, and Roger's a great place to start. That's going to wrap it up for today's program. I'd like to thank Roger Furrer so much for joining us and sharing his expertise with us. We explore a new topic each week, so please tune in so that when you're faced with your next business decision, you have clear vision when making it. If you enjoy these podcasts, please consider leaving a review with your favorite podcast aggregator. It helps people find us so that we can help them. Once again, this is Mike Blake. Our sponsor is Brady Ware Company, and this has been the Decision Vision Podcast.